and today we are going to be talking about credit. And you don't need to look at my face the whole time. I want to point out before we get started that this webinar is for informational purposes only and does not constitute legal advice. And my name is Andrea Johnson. I am the Grant and Financial Education Coordinator for the Office of Consumer Credit Commissioner. First, before we get started, I also want to mention what the Office of Consumer Credit Commissioner does. We are responsible for licensing and regulating certain non-depository institutions. Let me fix that. It's a little big. There's something off screen here to make things easier. And we protect and safeguard consumers against abusive and deceptive lending practices. We educate consumers and creditors about their rights and responsibilities. We also provide consumer assistance. Here are the different entities that we license and register. For instance, we license pawn shops and payday loan companies, and our agency registers debt management and manufactured housing creditors. We also provide consumer assistance with our consumer assistance team. We review concerns or complaints. We investigate and act as a mediator between you and the creditor to come to a resolution. If you have any concerns or complaints about any of the industries we license or register, please contact our consumer assistance helpline. There will actually be a real person on the other end of the line to help answer any questions you might have. We provide financial education through me, for instance. I am the Grant and Financial Education Coordinator. Informational seminars and webinars like this one. We hand out financial education materials that can be found on our website, occc.texas.gov. And that's also where you can find registrations for future webinars. We do public service announcements and press releases, and we have partnerships with other education-oriented organizations. This is where I like to mention our Texas Financial Education Endowment. So if you or an organization you know of is already doing financial education programs, this is a good resource because we grant funds for organizations across Texas who participate in financial education for K through 12, adults, and financial coaching. Again, I want to mention that this webinar is for informational purposes only and does not constitute legal advice. I've got a couple polling questions today. The first one I want to do is, why do you need credit? So, do you need credit to get a job, get a phone, buy a house, or rent an apartment? Why do you think you need credit? What is the most important part of getting credit? Is it one of these? Is it all three of these? What is most important to you when it comes to doing credit? So all of you answered buying or renting a house or an apartment, and that is very true. That is a big component of what credit is and why you need it. Credit is the privilege of buying services or goods with a promise to pay later. However, the answer to our last question was that it is helpful for you to get a job, spread out payments, get a phone, credit cards, qualify for insurance, finance a car, get a loan, or rent an apartment, a house, or purchase a house. I mentioned the fact when it comes to qualifying for insurance, I think of those commercials where like, great low rates. Well, those low rates also play a part in your credit score. So when your credit is good, your car rates will be lower when it comes to insurance. There are three different types of credit account categories. There's open, installment, and revolving. Open accounts typically have a balance to be repaid in full every month. Interest is usually not charged. Hold on, I got ahead of myself. I'm sorry. There is no pushing your debt to the next month. no installment payments over long periods of time, and generally no interest is charged. Examples of open accounts include company charge cards, cell phone accounts, and other home utilities. Since the balance on these accounts is typically paid in full each month and no interest is charged, these accounts will not always be reflected on your credit reports. Companies typically only report open accounts when they are delinquent. What this means is that, let's say you let your phone service, an old phone bill go to the wayside, then that bill will be reported on your credit report. I do have allergies today and they are making me cough. So if you don't hear me and things get quiet, it's because I've muted muted the mic so I can cough. Now let's talk about installment loans. These are typically for merchandise, services, and loans repayable in 2 or more regularly scheduled payments. They may be secured with a personal property or unsecured. Unsecured means the loan will be repaid by putting a lien of credit on an asset you own, such as a car, title loan, and mortgages. Unsecured means the loan is given without any collateral, but usually has a higher interest rate like personal loans, student loans, and payday loans. Revolving credit is most credit cards. Depending on how much you use determines your minimum monthly payment, and the entire bill isn't due all at once, but can be carried over to the next month. The problem is, by pushing the remaining balance down the line, you face more interest charges. Home equity lines of credit also fall into this category because you borrow against the value of your home. Be aware of making minimum payments. For instance, if you owe $1,000 on a credit card that charges 18% interest, and each month you only make the minimum monthly amount of $20, assuming that you don't charge anything else on this card, it will take almost 8 years to pay it off, and your balance of $1,000 will end up costing you $1,880 with interest payments. So you've almost doubled what you charged on it by only making the minimum payment. Good credit versus bad credit. What does it mean to have good credit, and what does it mean to have bad credit? The way it looks to lenders is that when you have good credit, you are reliable at paying your bills on time. Companies are more willing to extend credit to you, and you may even receive lower pricing. Who doesn't want lower pricing? Bad credit can mean you have problems paying your bills on time, you have a high debt to credit ratio, that your bills are paid late, or you've abandoned debts altogether, or even filed for bankruptcy. How do lenders determine credit worthiness? They take into consideration the 3 C's. What are the 3 C's? Well, character, how a person handled past debt obligations, capacity, how much debt a borrower can comfortably handle, capital, that is your current available assets of the borrower, such as real estate, savings, or investment, that could be easily used to repay debt should income become unavailable. Another way a lender determines how much debt you can handle is your debt to income ratio. This measures your current financial obligations against your current income. Let's say you have 10% or less. You're doing great. You're in awesome shape. 11 to 20%, you shouldn't have trouble getting a loan, but as you approach 20%, you've probably taken on too much debt. 21 to 35%, you need to stop charging. Although you probably aren't having problems getting new cards, you are spending too much of your monthly income on debt repayment. And wouldn't you rather spend it on other things? Now, once you get to 36 to 50%, you need to develop a game plan to get out of debt. And that should probably also include a budget. One good thing about learning about your credit, understanding your credit, and your debt is budgeting. Credit reporting agencies. What is a credit reporting agency? Well, technically, it is a clearinghouse of consumer credit information that it maintains the information and it compiles credit information established by you, the individual or consumer, into a credit report. What is your role? Your role is to establish credit and check your credit file periodically for accuracy. Under the Fair Credit Reporting Act, you are entitled to a fair and accurate credit report. The Equal Credit Opportunity Act prohibits credit discrimination based on race, color, religion, national origin, sex, marital status, age, or because you get public assistance. The Credit Repair Organizations Act prohibits untrue or misleading representations and requires certain affirmative disclosures in the offering or sale of credit repair services. This act bars companies offering credit repair services from demanding advance payment and requires that credit repair contracts be in writing and gives consumers certain contract cancellation rights. So you still have rights thanks to this, and it means that any credit repair contracts need to be in writing. So even in the virtual age that we are in right now, you need that contract in writing. So my next question is, how often do you check your credit report? Do you check it once a year, twice a year, more than twice a year, or never? This question usually has some nevers that pop up. And we're going to talk about why you want to be checking your credit report at least once a year. So go ahead and answer it. There's not a lot of us on the webinar today, so we've got plenty of time to go over this question and plenty of time to go over any slides you might have questions about. And feel free to ask questions and we'll try to answer those as we go along. So it looks like all of you, almost all of you, 50% of you say twice a year, 25% of you say more than twice a year, and 25% of you say never. So it is a good chance, even if you don't think you have a lot of credit history, you should still be checking it at least once a year. And the reason why is that it's free. You can get your credit report free once a year if you just go to annualcreditreport.com. A big role you have in your credit is monitoring it for accurate information. Credit bureaus do not make lending decisions. They are there to maintain and compile credit information established by the individual or consumer into a report. If something is incorrect, you need to dispute it with both the creditor and the credit bureau. You can request a free credit report once a year from one or all three of the national credit reporting bureaus, that is Experian, TransUnion, or Equifax. This is a good website to remember, annualcreditreport.com. Like I said again, you can get your free credit report at least once a year from there. So what's in a credit report? Personal identifying information. This includes your full name, address, spouse's name, your social, date of birth, and employment. What kind of account information is there? Well, it covers current balances, payment patterns, and when the accounts were opened. Public record information goes over any liens, judgments, or bankruptcies you might have, and inquiries display who has viewed your credit report in the last 24 months. What you won't find in your credit report is your race, religion, medical history, political preference, and criminal record. Your credit report does not care if you're a Democrat or Republican. Seems very timely right now. Credit scores. What goes into your credit score? Well, how long is your credit history? The longer, the better. Creditors want to see a pattern of responsible financial behavior, and the longer you have a credit history, the higher the number of points your credit score is going to get. You need a credit history to build your credit score. Time and responsible behavior are the two factors that go into this. It's very important. You'll notice that when you look up your credit report, you'll see credit cards that you've had open for maybe 10 years, and then you see, and you've constantly paid them off, you kept them in good standing, and then there you'll have a credit card that you opened last year. Well, that one that you've had longer and you've paid consistently and you've done a great job keeping up with it, that one means more. Oh, didn't mean to do that. What is your debt to credit limit ratio? The lower, the better. Your credit score will go down every time this goes up. Let's say you have a credit card with a $10,000 credit limit and you are using $9,500, then you need to pay it down to increase your credit score. Don't max out credit cards. Try to pay them off every month if possible. That's a big thing that will impact your credit score. How many inquiries do you have on your credit? The less you have, the better. Like buying a car, financing, buying a house. Are you just applying for credit cards every time one is offered? If so, this is not a good idea. And that's applying for credit cards. Inquiries stay on your credit for 2 years. Do you pay your bills on time? This is a big one that will help build up your credit. You know, that cell phone bill that you have, make sure you're paying it every month on time in full. Are there charged off accounts, judgments, bankruptcies? That's another thing that will pop up on your credit report, and it affects your score. Credit scores typically range from 350 to 850. The higher the score, the easier it will be to qualify for the best credit terms. And who doesn't want the best in life when it comes to just about anything, I guess? There are different types of credit scores. There's Beacon, FICO, and Vantage. FICO is the most widely used credit score. It ranges from 350 to 850. A score of 670 or above is considered good, while a score of 800 or above is considered exceptional. Now, my husband doesn't know this, but I do compete with him to see who has the higher credit score, and I always make sure it's me. So managing credit inquiries. How do you manage credit inquiries? Well, the fewer the better. I want to go back to that one. Only apply for credit when you need it. When applying for a mortgage or loan, do your shopping in a short time frame. I know this personally. We were approved for the house that we're in right now, and the person at the bank, she said to us, get a house under contract as soon as possible. And that's exactly what we did. Make sure you are regularly checking your credit report. That's a big one. So if you've never checked it, make sure you're checking it. Now, if you guys feel like I'm rushing through anything, just let me know. I can go back. We can go over anything if you want to. We have plenty of time today. There's a difference when it comes to a credit inquiry. There are hard inquiries and there are soft inquiries. A hard inquiry is when a lender reviews your credit report to make a decision. This can be a mortgage, auto, or credit card. It's considered hard because these inquiries are tied to a credit application. Hard inquiries can affect your credit score. Soft inquiries are when you check your credit or when a lender checks for pre-approval. These inquiries do not impact your credit score. So when you're going to your mailbox or your inbox and you see those pre-approval letters from all those different banks and credit cards, that's just a pre-approval letter. Now, once you fill out the application with that pre-approval letter, or you've logged online and filled out that application, then it becomes a hard inquiry, and that will show up on your credit report. So when it comes to credit cards and inquiries, is it good to have several inquiries on your credit report? Yes or no? I'm sure all of us will answer this correctly, hopefully, if we were all paying attention to what we were just talking about. and it does make a difference. This question kind of makes sure everyone is on board and with us today. So the good news is everyone answered no. It is not good to have several credit inquiries. That does affect your credit score. So everyone gets a gold star today for answering no to that question. So when it comes to repairing your credit, you need to be patient. It takes time to repair your credit. It can't be fixed overnight. Delinquencies remain on your credit report for 7 years. Public record items, such as tax liens, remain for 7 years. Bankruptcies may remain for 7 to 10 years. Unpaid tax liens, I totally misspoke, sorry. Unpaid tax liens remain on there for 15 years. If you are, when we're talking about public records and liens, sorry, we're talking about, for instance, I had to sell a house and had the foundation redone on it. And what they did was I think it's a contractor's lien on it. And so what happened is the lien was set against the house for the foundation. And then when the house sold, that lien was paid immediately upon the selling of the home. So that is something that would be on a public record. That's the type of lien that would appear there. I just want to clarify that. So how do you dispute inaccuracies? If you discover any inaccuracies on your credit report, you need to complete the request for reinvestigation from the credit reporting agency sent to you, or you send a letter listing each incorrect item and explain exactly what is wrong. If an investigation does not resolve your dispute, you can add a statement to your file of 100 words or less, or you can contact the creditor. Both of those things should be done in order to accurately dispute anything you find on your credit report that is inaccurate. Here is an example of the dispute process. First, the consumer notices inaccurate information on your credit report because you're going to start checking it at least once a year by going to annualcreditreport.com. Then you're going to dispute the inaccurate account with the credit bureau. The credit bureau will check with the creditor to verify the information. The creditor then has 30 days to investigate and respond to the credit bureau. If the creditor doesn't respond, the information must be removed. If the creditor does respond, the item will either be deleted or verified. A new copy of the credit report is sent to the consumer. Consumers are entitled to a statement of no more than 100 words to explain the negative remarks. So, even if you go through the whole dispute process, there is a timeline of how this is going to happen. The creditor does have 30 days to investigate and respond to the credit bureau. So, it's not going to be an overnight thing. I'd like to point out that, when you go to the store and you swipe your debit card, you're charged immediately. You see that money immediately disappear. But if you were to return the item, it takes up to a week to get your money back. So it's kind of the same thing. That item is going to show up, you're going to notice it, and then there's going to be a time frame of when it's going to be taken care of. So you do need to have some patience when it comes to this process. What can be changed? Now, when it comes to your credit report, some things can be changed and some can't. For instance, errors can be changed. Accounts that aren't yours, inaccurate payment history with proof, and any old information. What can't be changed? Information that is true. Information within legal timelines, such as bankruptcies, public records, history of payments, and accurate credit inquiries. So, for instance, those bankruptcies can be 10 to 7 years. And that means they're going to stick around for 10 to 7 years. And there's not really much you can do about that. So if you notice any inaccurate information, you notice you're like, oh, this looks like identity theft. All these credit cards are being opened in my name. What can I do? Well, there is something you can do that's either a freeze or a fraud alert. Sorry about that. But should you place a fraud alert or freeze on your credit report? A freeze generally stops all access to your credit report. It is available to anyone, but it is temporary until you remove it. A fraud alert, a business must verify your identity before issuing you any credit, and it remains in effect for 90 days. Fraud alerts are usually only available to victims of identity theft, and they last for 7 years. Well, an extended fraud alert can last for 7 years. To place a fraud or alert or freeze on your credit, you must contact at least one of the 3 major credit reporting agencies that we just mentioned by phone or online. They're not going to contact you. There are a couple credit reporting myths to point out. For one, the credit bureau denied me credit. The credit bureau does not make lending decisions. When paid, the bad debt will be removed from my credit file. Well, that's not true. Negative history remains on your file for the allowable time permitted by law. I always point out an example of this is bankruptcies, 7 to 10 years, depending on how it's filed. Keeping your credit in check. There are a few things you need to do to keep your credit in check, to not only build your credit, to understand your credit, to work on your credit. You need to live within one's income. This is a basic rule of sound money management. This means if you every month are coming to a point where you are using a credit card to make ends meet, then you need to build a budget and you need to see what is going on, that you are living outside of your means. You also need to look into increasing your income, maybe getting a second job. You need to cut out impulse spending, because this can also lead to financial problems. I always ask the question, is it a want or a need? That is the biggest question, because the biggest question you need to ask yourself when you're out and about, when you're shopping online, when you're picking up groceries, is this a want or a need? Because if it is solely a want, it is probably impulse spending, and you can cut that out. If expenses exceed your income, you have 3 choices. You can increase your income, i.e. maybe get a second job, reduce your expenses, so build a budget and see where you can cut things, or you can go into debt, but who really wants to go into debt? If your income exceeds expenses, the extra money can be added to savings or used for other purposes, such as paying down debt. So for instance, let's say you get a raise or a promotion and you start making a little bit extra every paycheck. It doesn't even have to be much, maybe $20, $30 each paycheck. Well, take that money and put it into a savings account. You never saw it. Make a direct deposit, set that up so it'll just automatically go there. Or take that extra money and pay off one of those credit cards that you have. We're going to go over some different debt repayment options, and so that extra money will be good to be using towards that. What about reestablishing your credit? Well, if you are working on reestablishing your credit, there are a few things you need to take into account. Stability in employment. I will tell you that when I purchased my first home, I was still in my 20s, and one of the things they noticed is that my employment history was all similar. I worked in the news for many years at that point. I might have worked at different news places. I can't think of the word right now, but it was all in the same background. It was all the same employment history. They also looked at my payment history as far as paying my bills. And at this point, it was my rental history, and I wanted to now have a mortgage. Remember, when it comes to reestablishing credit and building your credit, that you need to have patience. It takes time to rebuild your credit. You need to work on one thing at a time. So if you find inaccuracies on your credit report, you need to work on one thing at a time and work towards getting those things taken care of, or work on, if you, instead of running out and buying and getting 50 million credit cards, or trying to get a credit card, a car loan, a home loan, a personal loan, trying to do all of these things at once, just find one thing that works and do that. And one way to do that is to apply for a secured account, either a loan or a credit card secured by a small savings account. All of these things can be tied together. So to reestablish your credit, to build your credit, you can get a secured account. Let's say it's a secured savings account that is attached to your $30 direct deposit that you put in every single month. Bam, they all just are going to connect together. You want to also consider the pros and cons of debt settlements. One pro is that debt settlement may help you pay off your debt for much less than what you owe, but on the other side of it, it will impact your credit, and it could be on there for quite a while when it comes to debt settlements. Now let's talk about debt repayment. There are a few things you can think of. Debt snowball. This is paying the minimum payment on everything and then adding extra to the smallest balance that you owe. What I like about the debt snowball is that you're going to see almost immediate response to this. Because if you're paying that smallest balance and leaving the others, then that smallest balance is going to be taken care of quickly. You're going to see it paid off. The debt avalanche. Pay the minimum payment on everything, and any extra goes to the highest interest rate. So you may not be paying off that smaller card fastest, but you're going to keep really picking at that highest interest rate, which is what is charging you the most, which is going up the fastest because the interest rate is higher. Look to consolidating credit cards. You want to consider balance transfers, but watch for the fees. You see a lot of things that say, oh, 0% interest for 12 months on all balance transfers. At the end of those 12 months, are you going to have the debt paid off? If you are not going to have the debt paid off, you're going to wind up in the same boat you were in at the end of those 12 months. Now, if you haven't already, you need to stop using credit cards or other debt to finance living expenses. So if you're in a cyclical pattern of, using credit cards every month to help make ends meet, try to figure out a way to stop that. Like allocating extra money for debt repayment, which also could mean having to get a second job, or, is everyone in your family contributing? If everyone living under the roof that is able to work and is working, are they contributing to the debt or paying the bills every month? Ask for lower interest rates. I know that might sound a little crazy, but it never hurts to ask. Contact your creditors to ask for lower interest rates. Some might just surprise you. Now, when it comes to understanding your credit, it can help you do more than just raise your credit score. It can give you consumer confidence. I say this because I am a stickler for my credit report. I stay on top of my credit score. And when I went to buy a new car in May, we needed a newer, bigger vehicle because the kids are getting bigger. And I walked in the door and they say, oh, well, let's send this out and see what banks can do for you. What you can get. Let's send this out to all these banks and credit unions and see what's out there for you. And I said, no, I'm good. I said, I don't need you to look at my credit report, my credit score to know how I'm doing, because I know exactly where it stands, and this is what you're going to do for me. And I had a ton of confidence walking in there that day. And with that confidence and with that higher score, you're going to save money because you're going to get the lowest rates. It's also going to save you time and stress. I did not sit there all day waiting for them to figure out what they could do for what I needed to do in order to make the deal happen. It was, what can you do for me to make this happen and get me what I want and what I need? It also helps you take control of your finances. So if you are aware of what your credit score is, your credit history, your credit report, you can take control of your finances, and that's not something that's going to control you. When you step out the door and you're going to get that new apartment, that new car, that new house, you need new appliances for that new house. You know what you're dealing with. You know what you're working with. You know that you can be confident as you head out there because you're in control of your finances, your credit report, your credit score, your budget. You know how to build your own wealth, whether that is a new house, a new car. All of those things will come together, and that is the biggest part and the most important part of understanding your credit is you being in control of your finances, of your financial picture, of your financial wellness. And that is a big part of credit. And it may not sound like it, and you may think credit and budgeting, it's all about money, it's all about my credit score. But it plays such a big role in the things that you want and need to get where you want to be. It talked about employment. Maybe you want a new job. Maybe you want a new promotion. Maybe you want to move on. Your credit plays a big active role in that, and that's why it's important, and it should be important to you. So again, my name is Andrea Johnson. I am the Grant Financial Education Coordinator for the Office of Consumer Credit Commissioner. Today we were talking about credit. Next week, I am talking about how to avoid senior financial exploitation. So if you are thinking about moving into the retirement category, if you know someone who is older, your mother, your sister, your brother, your mom, your dad, your grandparents, let them know about my webinars. Like I mentioned, financial education for all ages is important. Another one that's going to be on the horizon is K through 12 for youth. Maybe you've got a junior or senior sitting at home right now doing virtual learning, and they've got, an hour to 40 minutes, and they want to learn about the basics of credit and budgeting and building wealth. That's going to be one for youth, young adults that I'm doing. And it's just going to go real basic information on why your credit is important to you, the basics of budgeting, and what that means as those seniors are heading out the door next year, maybe getting their first apartment. Maybe you've got someone who's going to be financing their first car, so that might be important to them. If you have any questions today, you can email those to financialeducation@occc.texas.gov. I will be getting back to you. If you would like the handouts from today, you can also email me there and I will send those to you. There will be a short survey after this webinar, and the handouts and video will be available in the future. Please contact me if you have any questions, and I look forward to hearing from you guys, and hopefully you can log on to my future webinars as well.